Morning, everybody. March 12th. I hope everybody's having a good start to your day. We are still dealing with the after effects of daylight savings time. I'm not having it. And given the fact that this market just continues to break down the way it does, that's why we're here. We're doing this morning BRRR until we find a little bit more stability. But for right now, the key thing that I want you to be focusing on is why you're here. You're here because you're looking for answers. You're here because you're trying to make sense of what is happening in this market. Why does it feel like there's something bigger than the Iran war? And if you've been going back in this kind of sideways market that's been transpiring going back to October, it really lies in a lot of the things that we describe here, me and the Money Printer, at Money Printer Pro, and of course at Postcards from the Edge of the World. And that is that waterfall effect, that focus on liquidity, momentum, insider buying, other elements around public policy that are extraordinarily important, but tend to go ignored largely by media simply because it's boring on purpose. It's not the most exciting thing in the world, but it is what drives equity markets. It is what tells you exactly where equities are at any given moment and where they're likely going to go based on probability reversion and momentum probabilities. So that today, if you didn't understand a word I just said, we're going to dig into some of these things and we're going to talk about what is happening right now. We're going to dig through the market. We're going to show you what insiders are doing with their money. We're going to show you our momentum reading, which is an extraordinarily important quantitative figure that everybody should be using and everybody should be analyzing every day, because back to February 21st, 2020, when we first started doing this, when this thing goes red, you better be hedging, you better be playing defense. And right now it is screaming at us that there is something deeply wrong in these markets. It is Thursday, March 12th. We'll talk about oil being above $11, Iran threatening $200. A private credit crisis continues to burn. And of course, fertilizers shock, which doesn't sound important to you on a Thursday morning. But if you watched the video that I cut for Money Printer Pro, everybody, on Sunday night, it was one of the very top warnings, and we've seen CF Industries and Mosaic absolutely run this week. Across the board, real quick, just so that everybody knows what's happening pre-market, we currently are looking at a S&P 500 at 6743, which doesn't sound too bad considering that all-time highs are up around 7,000. The NASDAQ's off about 137 points from 25,000, and the Russell is under pressure. WTI crude at 91. We're seeing gold sit just below 5,200 and silver at 87. The U.S. dollar gaining a little bit of strength with that index at 99. Once again, we have to keep a close eye on the U.S. dollar, because if the U.S. dollar rises, that creates stress in the collateral markets. It creates stress in the refinancing system, and it can lead to more problems in the private credit space. All right. So, once again, the rundown today: fertilizer prices, private credit accelerating, Brent moving higher. We'll talk about our momentum indicator and the companies that are reporting earnings. Initial jobless claims. Wow, got that backward, didn't I? 7:30 in the morning. Here, let me have another cup of coffee. Fantastic. All right, 8:30, we'll get that. We'll get housing starts. And the PCE price index comes out tomorrow. That is the Federal Reserve's preferred inflation gauge. And remember, that figure is going to be before the war. So before rising energy prices, before rising natural gas prices, fertilizer prices, and expected food prices. We're going to get that number. Adobe will report after the bell today. Very important name, given the fact that Adobe has just been doing what it has been doing as far as a price movement goes. This has been one of those software names that has been beaten up around the speculation around the impact of AI. Stock going from 440 back in June of last year down to around 272, with that real significant drop toward the middle part of February, when there were deeper concerns about the impact of Claude and other AI. Company expected for about non-GAAP EPS of $5.87 on revenue of 6.3 billion. But I want you to keep something in mind. It's not really about what their report says today. It's about what their guidance is. Where are they looking out? 6 months, 12 months. Right now, the price action that you're going to see on a name like Adobe is going to be the result of positioning ahead of today's earnings. So, what are large institutions doing ahead of Adobe? Well, they might be buying puts, they may be repositioning, they're taking on risks, they're taking off risks. They're basically making bets on what they think is going to happen, but also protecting themselves and playing defense. So a sharp move to the upside tomorrow may be just the result of lifting hedges, covering shorts, and then we'll see what the trend does after that. On top of that, you got Dollar General. Dollar General is a very important name for this economy, largely because, once again, the low end consumer is under pressure from expected rising gas prices. Where will Dollar General forecast? Where will they look at in terms of their guidance? And we have to keep a very close eye on this. I will note we're going to talk about insider buying in a minute. Another company in this kind of discount grocery space just saw a significant amount of insider buying. So that can provide us with a little bit of optimism there. The Dollar General 138 has been peeling back from that 160 level. We'll be watching that after the bell as well. Finally, Team. Nothing good happens with Team, another software company that has been beaten up pretty badly by the speculation around AI and the impact. Here is a huge move to the downside from around 340. This stock was absolutely, it is the definition of the at-home stock movement in 2020 and 2021. All the software to help manage people across the galaxy of at-home workspace. And now the way that it has been beaten up, this was beaten up on the negative side of the liquidity cycle. It got some legs back. And now as the liquidity cycle peaking, combination of AI reductions, it just continues to bleed off. And by the way, it ain't profitable. So Team, this has been a name to short for quite some time. And now cutting 1,600 jobs, 10% of its workforce. It just goes to show you the trend and the impact of AI in the software space. Our chart of the day, huzzah, is this. Okay. Now, I know nobody's live with me. I know there's no chat. I don't have anybody to respond to. So I'm just going to make my own friends up. Guy in the corner. Korea, Japan, Europe, they have the largest energy import exposure to all of this and what's happening with Iran. And this chart from Bank of America Global Research is suggesting, hey, like these are the nations that are going to get beaten up. That's kind of where the focus is with this chart, right? The energy dependence, the imports as a percentage of their energy consumption, but then their own sector as a percentage of their own market capitalization. So South Korea, Taiwan, Japan, Germany, like not a lot of energy stocks that are a percentage of those names. Now, why does this matter? It matters because in a time of rising energy prices, well, let's think about the relationship between economic strength and commodity production. And then throw in the third thing, which isn't in this chart, which is something that I talked about at Postcards from the Edge of the World about 2.5, 3 weeks ago, in that you want to look for countries that are not only energy independent, have a significant energy output, but are also economically free, right? So they respect private property rights. They're places that you want to invest. Canada and Australia are at that level. And if energy prices remain strong, Canada's currency is going to benefit as a result of that. I look at this chart. I also see two other things that I think are really important. First is Brazil and Petrobras, which is paying a cartoonish yield. This looks like a hell of a contrarian name to play rising oil prices. Dividend at 7.2%. It's not an economically free nation, and if we're thinking about like Finland or Norway, but this has that combination of emerging markets, higher yield, And these higher yield, the big concern with this is naturally going to be built around, are they going to pay their yields? Is it a place that I want to park my capital? You don't have to stay here very long. You're just looking for a trend to ride. And this is very smooth, very clean momentum. And rather than, necessarily speculate on US oil and gas and down in the Texas and in the Permian, it is these types of names that can continue to showcase very strong momentum. And I like PBR toward around that $20 level, so long as momentum continues. And if oil prices do move toward that 150, 60, 175, PBR is going to run right along with it, as will companies that have very low debt levels. Looking at some of the royalty trusts here in the United States as well, that is very attractive. That's where I want to continue to try to focus on momentum. Final thing is just the U.S. Just keep in mind that the U.S. energy sector is a very small percentage of our equity market capitalization. And this is kind of now the time to ride those trends out. Higher energy prices combined with lower debt, good, solid management. That's what makes names like Occidental attractive, Devon Energy, even Diamondback, which had a bad day the other day. But again, some of these names continue to move higher. And someone made a statement in my comments yesterday suggesting, well, if oil prices are moving higher, why and there's so much opportunity, why aren't the drillers doing well? Halliburton is on fire right now, right? It started the year at 28. And then one of the other names that we were recommending somewhere else, Rig, is up monstrous. It's gone from $4 to 640. So I'm just going to note the upstream E&P, the drillers are doing just fine. And a lot of the names in the E&P space, they've already had significant runs. I mean, Occidental has just been an absolute missile this year and has moved from 40 up to 50, 56, which that's a 40% gain. So there's still opportunity here. If you're looking for ways to trade into this, again, I recommend that you look at potentially doing put spreads, sell with a high probability of profit, focusing on an 80% probability of profit, a 20% return, and an annualized gain somewhere targeting around 100 to 120%. All right. On top of that, again, we did mention this fertilizer food price shock. This is a real problem. And we've shown those charts of places in the Middle East. We're already expecting about 10% increases this year in food prices. That number is going to move a lot higher. And the reason for this is fertilizer story is very important. Out of the momentum stocks that we have, Capital Wave, where we follow momentum and the numbers of stocks breaking out versus breaking down, you can see that CF Industries is on our list. We don't have a lot of breakout names right now. That's the state of this market. So just real quick, as we note, you see fertilizer names, you see some of the refineries, and then a couple stragglers like Live Nation, which is actually a policy reason that the stock had been moving higher. Everything else is in finance, downside, real estate, financials, consumer defensive. A lot of these names like Kraft Heinz and General Mills beaten up. Just a note, everybody who is a part of the Money Printer Pro is getting access to this starting today. It is a huge benefit to be able to have access to the live screen and to be able to pull any single stock you want right now and know whether or not it is in a breakout segment, it is a breakdown segment, it is trading sideways. This is something to complement anything that you have that you are looking for opportunities. If you're a momentum trader or somebody's making a recommendation to you, it's important to note, where is this stock right now in its cycle of price movement? All right. On top of that, you have commercial traffic halting since the war started. You have Iran hitting various tankers. Wolf Research warning that fertilizer shortages could push agricultural costs higher. No kidding. But here in the United States, it's not going to create a significant impact here in terms of production. It's going to create problems with just prices going up. If farmers do reduce application rates, yields on corn and soy and wheat may drop. Remember, the United States, our primary crop here is corn. The bulk of that corn goes to ethanol and animal feed. We only eat about 10% of our corn, but it is an important export. It's a very important component for our animal supply chain, And once again, if corn prices rise, that is the put through to all meat, that whole supply chain, everything involved in it. That drives up food prices, that drives up beef prices, chicken, pork, everything else. We talked about this on Sunday. Remember, I do have an agricultural economics degree sitting around here somewhere. I like to dust it off every now and then. Private credit is a disaster. And don't tell me that I haven't been warning, because I just haven't stopped writing about this since October. I was asked last week, is this the MBS crisis? 2.0 bugaloo. The reason that I didn't give it a 10, and Michael pushed back on it, and I think that was fair over at the compound. The reality, though, was in 2008, the loans were bad. In 2026, the argument goes that we have liquidity mismatches. Well, here comes PIMCO saying that we have a crisis now of bad underwriting. And now the story changes, because now we're going to start to have a deeper conversation about what are these loans? How are they written? What did it look like when all this stuff was put together? Who rubber stamped it? And that's where you turn the narrative a little bit. Now, I did not argue that this was a bad underwriting issue, but I have argued that the opaque nature of the industry is problematic. What they were stuffing into various semi-liquid funds was bad. So we have to be very, very cautious about this at the moment. I compared this more to the crisis of 1907. Get your old hats out, boy. Get your best gal, right? No, the whole point here is you want to recognize that the more things change, the more they repeat. So back then, you had the trusts, you had liquid assets moving through these cycles. Back then, people couldn't line up and pull their money out of these funds. Today, they have these redemption windows, and the problem is the redemption windows, when they're opening up, everybody wants their money back. So Cliffwater was the big one this week. They were expecting 7%. They capped it at 7%, and 14% of redemptions. 14% was the redemption request. People want out. Blackstone, they capped it. They exceeded their 5% cap. BlackRock, 26.8 billion, 9.3% requested, capped at 5. And I just want to point something out. I don't think that this is just because of private credit. There's a lot of other stuff going on right now. We've got a war. We've got the concerns about rising oil prices. We have people who are panicking because the S&P 500 is under a significant amount of stress. And we get a couple more days like this. I'm not saying we're going to move to capitulation, but I think we're going to start to see 2%, 2.5%, 3% type days, because we're getting into this environment where there's really no one stepping in to try to buy at scale. Now, the insiders are buying a little bit, but they're not big numbers in any capacity. So we got to be a little bit cautious in this environment, and people are trying to get their cash back. So this is going to be a major theme, and we are at the top of a liquidity cycle. We've had a lot of support from the Federal Reserve. We're seeing support from the Bank of Japan. The reality, though, unfortunately, is that this is still a crisis. It may be a liquidity crisis. It hasn't become a credit crisis yet, but it's certainly showcasing that investors are extraordinarily nervous. And as I noted, we're kind of looking for that last snowflake that causes the avalanche. It could be the war. It could be rising food prices. It could be inflation. But the reality is, this is a very significant week for private credit, and the numbers are coming on the bad side for this. And it's showcasing us once again that, well, we just keep doing the same thing over and over again. Credit's tightening. We warned about this on Monday with MetLife. PIMCO expects mid-single-digit defaults for a couple of years. Now, that's not crisis level. And in fact, maybe we should welcome some of this, because, then we're not getting a bailout for virtually everything. And we talked about that on the compound last week, the idea that, there's no tolerance for bailouts. But if the liquidity mismatches are extraordinarily bad, if there is a significant problems in the banking reserves and there's issues in the repo where SOFR starts to scream higher over the Fed funds rate, and that's one of the things that we'll be talking about later today at Money Printer, this can get bad. So once again, this is one of the reasons why this market is under a lot of stress, and this is why we continue to see over here on our Screamers and Crashers screen, it's all the same stuff. It's regional banks, it's companies like Ares, it's companies like Truist. You got a lot of regional banks. You got a lot of BDCs continue to show up on deep value screeners. You're also seeing a lot of these private equity names as well. So you got to be very, very cautious. All right. On top of that, we have oil breaching. It's if you didn't know, oil prices are high, and if you didn't know that, you need to watch more of this show. Brent hitting 97. The IEA saying that they've cut about 8 million barrels per day this month. Hormuz flows down at 90%, largest disruption ever. Why does that matter? Because that's the amount of the disruption of the Red Sea number. That's how much traffic changed there. And that's significant because when all of those ships stopped going through the Red Sea and went all the way around around Africa instead, at least they had another way out. They don't have that here. You can move about 7 million barrels via pipeline out of the Gulf Coast, but that's about 20 million barrels that need to leave. I think it's even higher than that because I think those pipelines are near capacity anyway. I don't think they have 7 million in capacity right now, in spare capacity. So this is a significant problem. And now we'll start to see new phases of the war. We're already starting to see new types of drones going in and targeting very specific private forces in Iran. IEA saying the largest supply disruption in the history of the global oil market. Well, if that doesn't get everybody speculating in oil, I don't know what will. Iraq has closed its ports after tanker attacks. Oman has evacuated its oil terminal. I have been there. It's a big place. Hormuz flows down 90%. Macquarie's saying 400 million, 4 days of global production. Not much, right? But China has banned fuel exports, and this is how it starts. Other nations are already doing things. They're already moving. The United States tends to move last. We tend to tell everybody it's all going to be fine until it's not. So 200 a barrel, that's what Iran's warning about. Analysts saying $5 gasoline, if that materializes. We're at 357 on AAA. Iran is now threatening banks and digital infrastructure. And the Pentagon saying that this cost $11.3 billion in the first 6 days. Momentum is minus 44. Our weight is minus 17.4. That's important. That means that think of it as kind of like a tug of war, right? So the number of stocks breaking out versus breaking down, we have 44 more stocks breaking down than breaking out. The VIX is at 24 and a half. You have war, you have oil, you have credit tightening. And I've been warning for weeks, move to cash, raise cash, stay in cash. This went negative on January 28th. That's how far back we go. 2 days later, we had a huge crash in oil and gold and silver prices. A week later, one of the largest momentum sell-offs that we have had in 6 years. We had a crash in South Korea stocks, and now we've had this. And once again, the combination of the private credit with oil and war is making risk off the play. So if you feel like you're late or you're just seeing this for the first time, this is what I do. This is what I focus on, and I've been focusing on it for 6 years. I focus on trying to get you out of the way before something significant happens that people don't see. Now, we didn't see the war coming, but that's kind of the point. On March 7th, 2023, this whole signal went negative. There was not a single warning about regional banks being a problem. 4 days later, Silicon Valley Bank was gone. On August 1st, 2024, this went negative. There was not a single warning about what was going on in Japan. 4 days later, the Japanese Nikkei crashed to the worst level since 1987. By the way, this went negative on February 21st last year before the April crash. This is what we do. Okay, so we're focusing on money in, money out. The weight of the S&P 500 being as negative as it is, that means that larger cap stocks are pulling this thing lower. And it also signals, though, that the damage is not as significant at those top tier names, those Apples, those Amazons. The real problems are the bottom 493 in the S&P 500, because that's the difference between the weight and that 44 that you're seeing. The Russell, minus 175. It's been a disaster for a couple of weeks. Energy is crushing small names. A lot of concerns about inflation, a lot of concerns about the current state of affairs, and of course, risk off across tech. Insider buying, 13th day of the war. What are we looking for? Well, TSLX, I'm not buying it, but I will say 10.8 million is interesting. It's the largest BDC cluster tracked so far. That's a business development corporation. So you're seeing private credit insiders still stepping in and still buying. Name that really popped out for me this morning was Go. This is grocery outlet. This thing's been getting hammered this year, right? Down from 18. This is the discount model of groceries. And it's really beaten up. We're deeply oversold here. And that matters because there is a possibility for a trade. Maybe a 5, 10, 15% move. And you saw $2.6 million in purchases from 3 directors after a nearly 40% drop in a month. And we're seeing AMR. The coal stocks are getting bids as well. And that's significant. So we're seeing a couple of different things. We've seen purchasing in coal. We've also seen infrastructure on LNG. And if you read the piece yesterday in Me and the Money Printer, I was talking about the differences between, do you buy here domestically and do you try to build LNG ports, or do you keep investing over in the Gulf states? And I think the argument is pretty clear. The infrastructure is going to continue to be built here. There's a couple other buys here: CPRI, AVTR, SSP, ABG, SFM, which is Sprouts, and SRE. This is in the infrastructure space of the LNG exports. That's all I got for today. All right. We nailed it. We stuck the landing. Guys, this has been great. And gals, and everybody, whoever's here. I just thank you for watching me prattle on before I've had my 4th coffee. And if you have any questions, check us out. Me and the Money Printer is on Substack. Don't cost nothing. Postcards from the Edge of the World comes out on Saturday or Sunday, depending on how I feel on Friday. That covers geopolitics, macro trends, and the stories that shape the global economy. If you're looking for stock recommendations, Postcards from the Edge of the World is that. It focuses on the choke points of the global economy. Me and the Money Printer is built around liquidity, the Fed, what's driving markets, and of course, the numbers, the stocks that are breaking out versus breaking down. These are the momentum names. People who are members of Money Printer Pro are going to get access to this reading. They can check it anytime. You don't have to wait for emails from me. We also have another tool on here, which is an options profit calculator, so that you don't have to go onto sites that have crazy amounts of advertising. This will do the math for you, but there is a 15-minute lag. I'm just going to warn you from where we pull our data set. That's all I got for today. If you are interested in insider buys, we have the insider buying dashboard at insiderstockbuys.com. If you are a member, you know what the guest password is for now. You can go on there, check it out. If you're learning about insider buying for the first time, why it matters, what's so great about it, we got a whole library of different things, including the word count, so you know what you're getting yourself into. I hope everybody has a great trading day. I will catch up with you tomorrow. Right now, I'm going to go shoot my traditional video with my Money Printer Pro crew, and we'll go from there. Any questions, just put it in the chat or hit reply. Enjoy your day, everybody.